We have ourselves a spicy one today. Get your calculator ready before you settle in for this one. I'm going to weigh in on the financial war that us nerds have been battling for over a century now. Is it best to grow our wealth with growth or dividend stocks? And additionally, what's the best way to stay wealthy once we get there? In this video, I'll discuss a variety of misconceptions on both sides of the fence, and we'll also touch on why this may be the most pointless war of all time. We are all winning if we consistently invest and we stay true to a system that works for our needs. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please 1-2-step that like button, subscribe if you haven't already, and drop me a comment down below with anything that comes to mind while you watch this video. First and last plug of the video is to check out my link in the description below if you or a friend of yours is interested in seeking Alpha Premium. It's the best way I've found to research stocks and ETFs, and the link below will save you 20% on your first year. It's that time. Let's grow. Dividend stocks. I should start with a confession here. I love dividend stocks. And a quick side note before I dive in, I primarily invest in ETFs instead of individual stocks. But for the remainder of this video, I'll be referring to everything as stocks just to keep the flow going. We'll start with the high-level concepts. Dividends are typically paid by well-established companies. Companies that have been around for a long time typically have well-established products or services that consistently make money while on autopilot. It will eventually elect to pay its owners, or us, the shareholders, some of the profits once the expansion opportunities have dried up. And dividend-paying companies typically do a lot better in market downturns than the growth counterparts. It will be business as usual in any market. Think of Procter & Gamble or McDonald's as a couple examples. And many of these dividend-paying companies will consistently increase the amount of dividends that they pay every single year. In fact, there are over 50 dividend kings right now. This group has increased its dividend payments every single year for at least 50 consecutive years. And do these dividend-paying companies cut their dividend from time to time? Of course they do. But if you own a basket of these reliable companies, you can count on your cash flow to increase as the years go by. It will give you a lot more consistent cash flow than using something like the 4% rule. And I'm not saying it's better cash flow as far as a higher ceiling, but you know what you're going to get each and every year, and it steadily improves regardless of the market conditions. And US companies that pay qualified dividends provide retirees with a way to capture tax-efficient income. Taxes on qualified dividends are treated the exact same way that long-term capital gains are. You will pay less than you do on your ordinary income, and it will not push you into a higher tax bracket. One thing that I don't think is well understood by the masses is that long-term capital gains and qualified dividends are accounted for entirely separately from your federal taxes. Said differently, these qualified dividends are better income from a tax perspective than interest from a high-yield savings account or non-qualified dividends from a money market, withdrawals from a traditional IRA, ordinary income, social security income, money from a pension. All of those kind of things count as ordinary income. What happens on your taxes is all of that ordinary income is accounted for, and that establishes your marginal tax rate, where your last dollar falls on the US federal tax tables. And then after all of that, your qualified dividends and long-term capital gains are tacked on at the end at a special tax table that's a lower tax percentage regardless of where the income got you. And I think a lot of times people hear this nerdy stuff about taxes, but it doesn't really set in. It's more powerful than people realize. If you're married filing jointly in retirement, let's say, and you have under $123,000 of income coming in from Social Security, pension, and other sources, interest, dividends, etc., you will pay 0% taxes on your qualified dividends from a taxable account. A common criticism of dividend-paying companies is that they're wasting potential growth by paying the owners the dividends instead. The money that is paid as a dividend to the owners will directly reduce the share price. It comes out of the company, so there's no such thing as free money in dividends. One of the things that newer investors that emphasize this oftentimes don't understand, and I gotta tell you, it genuinely drives me crazy, is that the total return metric encompasses all of this within the net math. Comparing total returns to dividend stocks and growth stocks is apples to apples. And as a side note, always make sure that you are using total returns when you're comparing two stocks. Most graphs and charts online will default to price return only. And the difference can be huge between the two metrics. Let's use my favorite high yield asset as an example here. Longtime viewers of the channel might have already known I was going to pull up none other than JFT&x. So I'm out on Seeking Alpha and I've pulled up JFT&x and I'm on the charting tab here. So by default, what I did here, I actually put in a custom range because JFT&x isn't quite 3 years old. So it's from inception. We're showing the last 811 days. I went from 5/4/2022, which is when we started getting data on JFT&x. And I can tell you that JFT&x has outperformed the market. Wait a minute. JFT&x is up 7.25% to the market's 29%. Where have I gone wrong? Well, this is just showing the price return. Again, the default graph. If we go to select metrics and pull total return instead, sure enough, JFT&x has outperformed the market over the past 2 years and change at 36.4% to 33.8%. So always make sure you're looking at those right metrics. Those dividends trickling into a total return tell a completely different story. And just to show a less obvious scenario, I actually pulled up SCHD and VIG. VIG is a great growth dividend ETF, and SCHD is more of an all-around dividend ETF. It has a solid yield and some quality dividend growth as well. But you can see if you look at the last 5 years, VIG has crushed SCHD if we're just out here on the default charting. But again, in a similar concept, if we go to total return, they're basically about the same in the last 5 years. So instead of VIG being way ahead, when you add in all those qualified dividends for both of them, SCHD takes the slight lead. So the dividends really do compound within total returns. And believe it or not, dividend paying stocks have outperformed non-dividend payers for many decades now. And we'll get more into that, but not before we touch on growth stocks. Growth stocks. I have another confession to make. I love growth stocks. Growth stocks do not generally pay dividends. They take that money and they reinvest it back into the company for future growth opportunities instead. Growth stocks are really the opposite of value stocks, not necessarily dividend payers. But dividend stocks are also the rivals of growth stocks in a typical investing debate. We'll pay more money to buy growth stocks as the price to earnings ratio is higher based on the projected future growth. It's worth paying double the price to earnings for a company that will 10x those earnings in a few years. We are betting on the future. Think of the technology sector in general, or a more recent example, AI within technology. We'll pay out the ears for these stocks for the potential to hit it big. The beauty about growth stocks is that you can produce your own qualified dividends as you need cash by simply selling some shares. If you hold the asset for at least 1 year and then sell it, you'll produce long-term capital gains. And as we touched on earlier, they're treated the same as qualified dividends and favorably to our typical ordinary income. That's one of the biggest arguments against dividend investing, is that a lot of people don't want the dividends paid as they're accumulating, just to avoid the taxable events, even though at the end of the day, it's all the same, those long-term capital gains versus the qualified dividends. But when you work off long-term capital gains, you can only take what you need real time. I could talk about growth stocks for hours, but let's dive into our comparisons before you fall asleep. Best for wealth accumulation. We must first address the elephant in the room. There is no clear-cut winner in this debate. There are a million ways to successfully invest your money. It really comes down to your age, your risk tolerance, and your specific goals. If you're in your 20s and you love dividend investing, do it. If you stay the course, you're going to get to your goals long term. Or if you're in your 60s and you love growth stocks and you prefer something like the 4% rule to produce income instead of dividends, go for it. You will be successful if you build and stick to a system that works for your situation. Look at it this way. If there was one right answer, then all the smart people would do the exact same thing. Now, with all those disclaimers out of the way, I'll tell you my preferences for getting rich and staying rich. We'll start by comparing the returns of the dividend payers versus the non-dividend payers that I alluded to earlier. Now, if you Google around this topic, you'll find that nearly every study for anything 20 years and longer, especially 40, 50, 100 years, will show that the total returns of dividend-paying stocks have been superior over the long run to non-dividend paying stocks. For example, we're going to look at the very first Google hit I got when I was researching for this video.
So I'm out here on that first article I found. It's a Yahoo Finance article, and it's just the 16 best dividend stocks of all time. But what I wanted to focus on, and again, you'll read these stats everywhere, I've never seen it the other way around when looking at huge macro samples of just data dumps. And it's referring to this Hartford Funds report that had some information about dividends. And it mentions that the report said that dividend paying companies delivered an annual average return of 9.17% from 1973 to 2023. So that's a large sample size, compared with a 4.27% return of non-dividend stocks. And this is cool and everything, but we also know the NASDAQ in its 40-year history has nearly tripled the market with the dollar cost averaging in scenario. I can link the video down below where I covered that. So we're not going to invest in most of the bad stocks that don't pay a dividend. So data like this isn't always overly pertinent to our decision-making process.
I've gone deep down the rabbit hole, maybe embarrassingly so, about the topic of factor investing, well beyond the scope of this video. And one thing I've learned is that I think we need to be very careful about big, unfocused data. And I'm not saying that the investing research that we have out there is incorrect. I'm not saying that at all. But we need to make sure that it directly applies to what we're talking about. This drives me crazy in some like growth versus value, small cap, large cap. I won't go into more details in this video, but we have to be careful that we're assessing apples to apples on what we are actually investing in. And for example, to get back to this video, think about it. Of course, dividend paying stocks are going to outperform non-dividend paying stocks when you pull in the whole world of both of them over any stretch of time. That's really just common sense. Companies that pay dividends have net earnings to do something with. Now, there are growth companies with huge earnings that they choose to reinvest into the company, but there are also a bunch of duds that are barely staying afloat within the market, whether it's a future growth company or just a business in general, that of course isn't paying dividends. We just need to use our common sense when reviewing research, I guess is all I'm trying to say here. I think quality growth ETFs are the best way for younger people to accumulate wealth over 20 or more years. There is a huge caveat to that though. We must never panic sell when it hits the fan. Will you be able to stay the course and continue aggressively dollar cost averaging in when you see your portfolio cut in half? Because if the answer is no, then it probably isn't for you. I should also mention that ETFs like QQQM, VGT, and SCHD are my favorite ways of gaining access to the growth market. And again, there's plenty of other good ETFs out there too. I'm just spitting out the ones that come to mind that are my personal favorites, but there's a whole bunch of different ways you can go. Handpicking individual growth stocks is very dangerous no matter how smart we are and how we slice it. You could 10x your money or go bust in the blink of an eye with individual growth companies. Best for staying wealthy. I think dividend stocks provide the best path for staying wealthy in retirement.
And to show an example of retiring on dividends, I wanted to highlight a YouTube channel out there. It's one of my favorites I've been following for a long time. It's Gen X Dividend Investor, and he retired on dividends in his 40s. He had a long 30-year investing career, never received an inheritance or anything like that, worked from the bottom up. And he's a huge advocate of having a dividend portfolio that increases their dividend payments each year in retirement. He doesn't always outperform the market, and he talks about it all the time, the pros and cons, but his cash flow consistently increases every year with the power of dividend growth. And when the market crashes from time to time, which it will, the blue chip stocks that he's invested in that are paying him these dividends take much less of a fall during the hard times. It's just an example of someone who does it right. He knows he isn't going to outperform the market all the time, but he also knows he wakes up every year with a little more cash flow than the year before through the power of his dividend stock portfolio. I've learned a lot lot from his channel, and I highly recommend it to anyone that's interested in dividend investing.
The thing I like about living on dividends in retirement is you can give yourself a 99.9% chance on those Monte Carlo simulators to make it to the finish line. This is due to the most underrated metric in all of investing, dividend growth rate. The value of your portfolio doesn't matter if you're producing enough cash flow to pay all your bills each year. And the cash flow itself increases faster than inflation. Let's see how the underperforming ETF SCHD has done in a retirement situation. And I don't say that snarky at all. SCHD in the last 10 years has underperformed the broad market indexes. But
I'm still in this specific spreadsheet from a video that I do once per year, retiring on SCHD. This is after year 11 of my scenario. We're going to strictly focus on the cash flow. So what happens here is this is a retiree that retired after 1/1/2013. So at the end of 2012, this person retired and they had $500,000 that in this scenario, they plopped it into SCHD. Dividend reinvestment is turned off for this scenario. And a quick note, when it was $76 at the end of 2023, that $500,000 was worth $1.3 million, again, without reinvesting dividends. But where we're at here is total dividend cash flow. This is per year what's received. This actually happened, no assumptions here. So in 2013, we ignore 2012 here because that was the year that they retired. So this is the first year of receiving dividends after purchasing SCHD. They had $15,000 of dividends, not too bad. But you can look, again, without reinvesting, strictly based on the dividend growth, the exact same amount of shares, we're spending it all and having fun. We're up to 18,000 the next year, then almost 20, then nearly 22. 23, a smaller jump there, 24 and change per year dividends. We had a big jump here at 29,000, almost 35,000, almost 39K. We're up to 44,000. And then we had a smaller year up to $45,700. So what used to pay 13.9K now pays 45.7K, and it's worth, not to mention, $1.3 million. But just the cash flow alone, this is the power of price appreciation plus dividend growth, the dividend appreciation. The crazy thing is the yield was around 3 or 4 for all of this because the price goes up from $29 a share to $76, about the same as the dividend payment per share going up from 81 to 266. So this nearly triples, this nearly triples. The yield is going to be the same. The yield is just what it pays divided by its price. People commonly look at a 3.5% yield of SCHD and say, oh, I'd rather have the guaranteed 5% from, a bond or something. It just doesn't make sense when you zoom out. But this is the power of living on dividends. SCHD is a pretty good benchmark for a balanced dividend portfolio, much like VU would be a good benchmark for, the market, that kind of investing, or QQQM maybe for growth. So I thought this would just be a fun example to show just the power of dividends. If you have enough, initially, you're going to smoke inflation over time and never run out of money, regardless of what the price action's doing. The 4% rule with growth-oriented stocks can get a little dicier in down markets.
The way that this works, and I've seen other people, smart people, like Rob Berger, for example, is one of my favorite follows, read his book, and I think he's a bright guy. He's very based and just says it how it is. He's mentioned that the 4% rule is statistically better than living on dividends in most scenarios. And he is 100% right. See, what happens is the 4% rule, and that's just when you produce income by selling. You use your dividends, plus you also sell some shares to take out 4% per year, and it adjusts for inflation, all this stuff. You can read more about the 4% rule. But when you run those scenarios, you usually end up with a much higher balance than you do with strictly dividend investing. Said differently, the 4% rule will very likely have you on your deathbed with a higher net worth, with a bigger portfolio. But dividend investing gives you the highest odds of being financially free all the way to that deathbed. Best for you. What do you feel the most comfortable with? You should probably start there, of course, after doing your research, and then build a quality system that works for you. If you work hard, save smart, and stick to your investing system, you're going to make it. We could argue about portfolio strategies until we're blue, but at the end of the day, time is the most important factor. Check out one of these 2 videos if you want to continue on down that rabbit hole to building generational wealth. Thanks for watching, and I will see you here next Sunday. Peace.